Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shubh, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Patrick, you know that introduction may or may not be very suitable for the topic we're about to discuss because we are talking about something becoming very tangible and real out of something which was perhaps very notional to begin with.
Hmm. And that is the topic of founder secondaries. Secondaries are the VC jargon or venture jargon for founders, can also be employees, sometimes investors, selling existing shares to someone else. Can be
Yeah.
another existing shareholder or could be an outside party. So the company is not issuing new primary shares. The existing shares get traded. And so the secondary or the founder secondary is what we're going to discuss here. And you and I are not going to reveal our personal opinions, also not fundamental opinions, but
Yes.
instead, Shub, we want to bring both sides of the argument to the table and leave it to the listeners, to the founders in AEC, Aztec, to decide what is right in their specific context. And how are we going to do that, Shub?
So I guess it's only appropriate that in a situation like this, I become the pessimist or a bear or a very negative person because that's who I am in real life, Patrick.
Yeah, that's right. So you're going to role play the bear and
Hmm.
represent the bear argument.
Yes.
Um, I'm going to take the bull argument for why founder secondaries are awesome.
Hmm.
Um, and we're going to role play through this,
Hmm.
and we won't reveal our true opinions on this,
Yeah.
just to represent how a discussion among founders, among investors could actually unfold.
Yeah. And for the benefit of our viewers and listeners, the reason we're choosing to role play in these specific roles is because this topic is actually very complex and extremely nuanced, very, very context specific. And therefore, it is impossible to have a very unilateral and uniform view on this subject, which applies to all situations.
Yes.
Or at least that's what a good VC should tell you, in my opinion. If a VC has very unilateral and uniform opinions that apply for all situations, then perhaps you should run away from that VC.
Yeah. Yeah. I couldn't
All
say it
right.
any
So,
better.
how about I kick us off with an extremely stereotypical VC 101 style argument against
Go
founder
Bears.
secondaries? Yeah. So, look, I mean, hey, I mean, venture is a tough business, tough road ahead, typically a very long journey. There's tons of variables thrown at you. One of the things which usually helps tide over tough times is when you think about, hey, you know what? The bigger the company goes or the better it does, I, as a founder, stand to benefit and have a massive payday eventually. And obviously, investors like that, which is where the concept of alignment of incentives come in, right? If you have, if everything you have or all of your net worth or an enormous share of your net worth is locked up in the company's ownership, you have all the incentive in the world to make it very big. And the argument is that, which is why with the founder trying whatever they can in their ability to take the company big, the investors benefit. And I think one of the most straightforward and classical arguments against founder secondaries is, hey, if you keep taking money off the table, at some point a situation may arise where what you already have through secondaries represents enough of a gain or a cushion for you so that failing is perhaps an acceptable option, right? And at that point, you're as a founder, you're disconnected from the incentives of the founders,
Hmm.
of the investors, I mean, of the investors. And which is why, if I were an investor in this point, I would definitely start to get little bit worried if my founders were getting a bit too excited about taking money off the table through secondary sales.
And just to understand, does the bear argument here, that does it change over the lifetime of the company?
I would imagine so. I would imagine so. So, say for example, if a founder were selling their shares at an IPO, right, or when the company is already public, for example, I mean, it's understandable at that point. I mean, all of us also, of course, finance our lifestyle, have other ideas, of course, want to get ahead in life, and so on and so forth. Have fun with the money we've rightfully earned. Um, in my personal opinion, or in the opinion of a person taking on being a bear on founder secondaries, I think that is definitely okay under all circumstances. A founder selling shares in his capacity as a public founder, or in her capacity as a public founder, as long as a significant chunk of their ownership still remains with the company. For example, if overnight a founder has sold half of their ownership, right,
Hmm.
in a company, even when it's already public, I would probably see that also as a warning sign. Maybe not a red flag, just to be clear, but definitely a warning sign that, hey, are they now checked out? Do they plan to transition from being a founder to executive chairman, quote unquote, right, or non-executive chairman, and therefore it's no longer a founder-led business? I would ask myself those questions.
And
uh,
it's interesting in the context of publicly listed companies because most jurisdictions or most domiciles for publicly listed companies have certain um, requirements for insiders, and a
mhm.
founder, CEO
Yes.
holding a substantial share will typically be considered an insider in these jurisdictions to actually make certain filings before being allowed to actually dispose shares. Does that have to do with their information asymmetry that they might have? Is that part of the bear thesis here?
I think so. You're right. It is part of that. I think it's also a reflection of, in most jurisdictions, it also changes the structure of how much of the company is available as a float in the
Hmm.
wider market. And for the benefit of our viewers and listeners, the float refers to the proportion of the company or the amount of the company held by non insiders or non founders or non. Actually, I'm not sure if it includes employees, but let's say for the sake of this discussion, we take insiders to mean founders, employees, and directors. Everyone else is treated as the float or the external outside market as outsiders. And I think what the outsiders want to know, and I think you're right, in most jurisdictions, insider ownership is to be reported and is seen as a signal of what they're doing as a matter of disclosure. In most jurisdictions and in most investing communities, you would imagine that the insiders have more information on how the company is doing today and where it's likely to go in the future, which is why an insider buy would be considered a strong signal in general. I'm generalizing here, and an insider sell might be a weak signal. I'm stressing on the might because there's several reasons for individual selling. And therefore, if even if a founder at the stage of being a very mature publicly listed company sold a very large proportion of their shares, I would start to ask why. Why is that the case? I mean, if they
Hmm.
still see continued upside, and as a publicly listed company, their let's call it basic needs and also higher needs of wealth creation and cushioning their lifestyle are taken care of, why do they need to dispose of a very large proportion of their holdings?
Right.
In my opinion, that would be a very fair question to ask. Now, I spoke about, sorry to interrupt you. I spoke in the context of publicly listed companies. I think at several other stages, it depends. If I were a bear, I would say, hey, if a founder is selling shares at seed or series A, it is definitely a red flag. Thereafter, I would say it may work, but it could also be a very negative sign and move the founder away from being perfectly aligned with the investors.
Okay. Perhaps two follow-up questions for the bears
Mhm.
when it comes to founder secondaries. Let me start with the first one. The fact that a founder then has more cash in the bank changes perhaps their perception of risk, something that you alluded to.
Mhm.
Um, how much does that factor into the bear argument here? That hey, it's better if the founders have less means available.
So now I'm maybe sprinkling in a little bit of my opinion into the bear argument. I think for me, or for a, let's say, well-informed bear, it perhaps is less about the absolute amount of cash that you have, let's say, withdrawn from the company. I think it's also a reflection of how much is still left unwithdrawn as remains as ownership in the company, and what how that represents as a proportion of what you've already withdrawn as or accessed through sold shares.
Right.
If I mean, as a hypothetical argument, if you have sold 5% of your shares, I think I would imagine the argument applies that, hey, to the extent of 95% of your ownership, hopefully, with most smart, intellectually motivated people, they would like to see that the 95% driving most of their business and professional decisions rather than the 5%. I mean, rather than the 5% sort of wagging the tail and driving the decision in that way.
Okay. Okay. Got it. Um, Second question to the bear. Has the bear seen instances where a founder did a secondary, let's say Series B?
Okay.
Afterwards, a down round happened, which is in part, to a large part, the founder's doing. And then the founder said, hey, I'm going to buy back shares with money. Has the bear seen such an instance? And if not, if yes, what's the bear's view on this?
So you're saying in this specific example, the founder was able to do, I mean, it's not a true arbitrage, but you could basically swap the same amount of shares and pocket the difference.
Also, perhaps the founder in this case sold at whatever, $1,000 per share. And now a down round happens a year and a half later, massively under the control of the founder. And the founder gets to buy back at 330 per share.
So I personally haven't encountered that example that you brought up, but there are very high profile examples out there in the venture world. Uh, like massive blow up type cases. For those interested, look up a company whose name starts with W, where you'll come across cases like that.
I think that name has two W's in it.
It actually that is right. It has two
Yeah.
W's. Yeah.
Okay. Yeah. Then, I mean, ChatGPT will have your answer.
Yes. I would imagine there probably are more cases of it than we realize. Now, isn't that interesting? I wonder what that, how that would be received. Because the bizarre thing is, someone would listen to this and say, "Hey, but and literally, I just said a few minutes ago that insider buying is a very strong signal. But if you gamify the whole thing, then you're not playing the game of value creation. You're playing the game of swapping shares in an arbitrage manner, where at least venture investors are not set up to win that sort of game.
So the bear would not like this.
No, the bear would not.
I mean, it's possible, right? All right. So let me take the bull argument here. So as a bull, I'm freaking loving founder secondaries. In general, I am not necessarily liking it at seed and Series A, because at that stage, there's not enough de-risked in the company. The company is relatively young. The founders shouldn't have the feeling of, oh, I invested a very long amount of my time, life, etc., into this business. So at that stage, it shouldn't come up just yet. But my argument as a bull is going to be, I'm loving Series B, C, D, E, F secondaries. And I'm loving them for the following metaphor. So imagine you have two farmers. So one farmer is starving and is just feeding hand to mouth family, right? So the field every year it just produces enough potatoes or enough crops to feed the family, but not enough to actually go purchase more land and take a bet on how arable the land next door is, right? Or to change perhaps the methods of increasing the yield, because if you can just about feed your family, you're not going to change the methods of you putting the field, because the risk of actually being wrong with that bet is very, very high for you. The reward is not very high for you at that point anymore. Now imagine that farmer has a neighbor, also a farmer, also potato farmer, and that person's yield is mind blowing,
Mm-hmm.
right? And so that person has stocked the barn with potatoes. They you can stock them for a long time,
Yeah.
I assume, right?
Mm-hmm.
What is that farmer going to do? Well, that farmer is going to seek methods in order to maximize the output
Yeah.
if they are still hungry. So,
Mm-hmm.
sorry, hungry in a metaphorical sense, not
Yeah.
hungry in this example. If they are still
Yes.
ambitious, if they are still aspirational, right? So perhaps they want to become the farmer king of
Mm-hmm.
their country, or they want to be, the potato king of their country. And so now, if
Yeah.
that aspiration and ambition is still there, this is the best point in time to actually take the bets on the next arable land and try to develop that on the next land after, or to change your methods in order to maximize the yield. Why? Because I'm safe, right? So I know I can feed my family.
Mm-hmm.
And I think, as a bull, again, this is the bull thesis, as a VC investor, it's completely funny to me as a bull how many VCs will love the second time founder that is exited. And that
Mm-hmm.
founder perhaps exited for 50 million. And we as a VC community attach success to it. And we
Mm-hmm.
also say, hey, I mean, it doesn't matter if that person has 50 million in the bank. They must still be aspirational. They must still be ambitious. Let's give them money for
Mm.
the second tour. But we don't do the same to founders on their existing journey. We kind of, as a
Mm.
VC community, we think, no, but if now I allow them a secondary at a Series B, God,
Mm.
God beware, it's a million,
Mm.
not 50, right? So God beware, it's a million. I hate that. It creates the exact same scenario, right? So
Mm-hmm.
as a bull, I think there's a massive logical disconnect between how VCs evaluate the situation of a serial founder that has money in the bank and the situation of a founder that they should already support and know today how that person actually acts and behaves, to put much lesser amount of capital into and to buy potatoes and put that into the barn, right? So I
Mm.
think there's a massive logical disconnect. I was listening over the weekend to a podcast from Dustin DeVan, former
Mm-hmm.
founder of Building Connected. He was on Bricks and Bytes
Mm-hmm.
with Owen and Martin. And he shared a bit his personal journey, and that is something that the bull thesis might feel strongly about. So Dustin said, "Hey, sorry, I'm paraphrasing. Dustin, if you hear this, I don't think I get you exactly right. Hit me up if I say something wrong, but I think I represent you correctly now." So what I heard Dustin say was, "Hey, we sold Building Connected for publicly announced 275 million.
Mm-hmm.
But I knew how to get to 50 million ARR. I thought I could get to 100 million ARR and beyond, but the stretch from 50 to 100, that was murkier for me. But I knew
Mm-hmm.
exactly what levers to pull to get to 50 million ARR. Now, just for context, Dustin didn't say this, but the implication is, bro, if you're at 50 million ARR, you're not going to sell for 275 million. If you're
Yeah.
at 50 million ARR, you're going to sell for 500 plus, right?
Mm-hmm.
Dustin continued saying, in the context of the 100 million, I was absolutely convinced we could make Building Connected a unicorn. I
Mm.
knew how to get to the 50. And after that, I would have liked to take the bet to get to 100.
Mm.
So now comes along. He said it wasn't the only offer. He had multiple offers to sell. 275 was the offer that they went with. And he said, on the podcast, hey, there were some health issues in my family, in my co-founder's family. Nothing. It didn't sound like it was whatever, like completely life destroying or life changing, but it sounded like they had struggles at the time a little bit. And I
Okay.
imagine he didn't say that. That also, of course, can put a strain on your personal bills, especially in
Yeah.
the US, where healthcare can be very expensive, right?
Mm-hmm.
Not saying that was the case here, but it might be in someone else's case. So
Mm-hmm.
now, if someone makes you the offer to sell your potato field for 275 million, and you think, hey, can I really be my neighbor's farmer?
Mm-hmm.
Or should I put more potatoes in my barn in order to become my neighbor's farmer, or
Yeah.
my neighboring farmer?
Mm-hmm.
It's very, very tough at that point to re-underwrite that you are going to decline that money, and you're going to say, no, I will continue hand in mouth, and I bet on myself that my methods of changing the field or buying more fields will actually allow me that in 3 or 5 years down the line, I will
Yeah.
beat my neighboring farmer and I'm going to be the potato king. So that is the metaphor. And the bull thesis here says, hey, what if Dustin at that point had received a million, two, or three? This was post Series B, so that's exactly
Mm-hmm.
the stage that the bull thesis here is talking about, had been allowed to put that in the bank.
Hmm.
Would Dustin, in this example, have said, you know what, let's go for the big outcome? I don't
Hmm.
know Dustin's answer to it, but the bull thesis would say, hey, that's exactly what would allow a founder like that in that situation to re underwrite going for the big outcome. And that's my
Hmm.
final point now. It's a complete disconnect with what venture capital and venture capitalists want a company to be. They don't back companies to get to a 50 million outcome. Venture
Hmm.
capitalists back companies to be the outlier, to be the $10 billion company. So why are venture capitalists not allowing the hand and mouth farmer to put some potatoes in the barn and then re-underwrite to really, really go big? I do not
Hmm.
understand it because venture capitalists are doing it for serial founders when they found new.
So takeaway number one is clearly that bulls love potatoes. So let's make sure we do not forget that or leave that undocumented.
Yes.
Moving to, I guess, more relevant stuff. Interestingly, what you posed as a hypothetical question to Dustin in different words was going to be my question to the bulls. For example, one of the questions I had was, say you find yourself with a series B happening, and I want to paint the picture of maybe a 2 by 2 matrix, or 2 by n matrix, where you have a situation where the valuation is quite a bit lower than what you'd consider is the right valuation for the company at that stage, and another situation where the valuation is quite a bit higher than what you think the company should be fairly valued at. In these two scenarios, is there either a certain amount or a certain percentage of ownership or percentage of
Hmm.
holding which you would deem to say, you know what, this is the right number from a bull perspective? Until this, it's okay, if the founder chooses to sell.
So, as a bull, what I would say is I would not. So it wouldn't be the first ratio that the bull would look at. What is the ratio of sold to retained? That would be the first thing the bull would look at. What the bull would probably look at as first is actually, hey, how much money is going into buying potatoes for the barn, and is that true? Like how much is enough to allow the farmer to re-underwriting going for a 10 to 100x now? And that will have to do, like you said, us leading in here, a little bit with the personal situation. So if you have a lot of healthcare bills in your family, if there's other like uncontrollable costs that will completely distract the founder from achieving what they ought to achieve, the greatness with the company, that number can vary and change. And also, I guess countries globally will be quite
Yeah.
different, and that context can change. So that would be the first ratio that the bull would look at. And the second would be what you said, so how much is actually retained. And so the bull would obviously, like the bear, prefer if more ownership is retained, because the incentive to go big will also be higher. But the first optimization level would be, hey, let's put enough potatoes in your barn for you to truly re-underwrite the 100x from here.
Understood. And from a bull perspective, you would not so much factor in, hey, the founder is choosing to sell. For example, if it's at a much lower valuation than the fair value, would that factor in any way in the assessment of the situation?
So in the bull thesis, not if the bull has enough information about the company themselves. So if the bull were an outside shareholder looking at this, probably the bull would have a lot of questions and would probably know that there's information asymmetry. The existing shareholders should be close enough to the company, especially at a Series A, B, and C stage, that they should have. There's always information asymmetry. I famously say on Practical Nerds that a founder has 1,000 times more information than the investor, but not all of this information has the same weight. Not all of it matters enough. So the things that matter, the investor should be the existing shareholder should be well informed. And so for them, actually, it shouldn't truly, as a bull, make the difference, because they should have their own thesis of what is going on in the company.
Okay, maybe I'll take one of all the things that you said and convert it into my second scenario or second argument. But before we go there, just to also be clear from the bull perspective, so you described an acceptable amount to take off the table in a secondary sale would be what is needed for the farmer to have sufficient number of potatoes in the shed, not be worried about not being in a sort of hand to mouth condition, not being worried about being able to feed the family, that sort of thing.
To
Uh,
re-underwrite the bet that they change the farming method or that they buy more land.
Gotcha. So what you're not saying is, for example, from a bull perspective, to support a transaction where the amount of money the founder receives would be what would be considered life changing in that situation, or something which they could hypothetically retire on if they so decided.
I don't think it would factor into my
Hmm.
part of the bull thesis because people retire on different kinds of stipends.
Mm-hmm.
So what do I know? How can I judge if a founder can retire on 3,000 a month and another founder with their lifestyle maybe needs a different type of
Hmm.
retirement? And so it would be for me as a bull quite impossible, like you said, to have this one number that
Hmm.
describes all uniformly all possible life situations in the
Hmm.
world. It's impossible, and that's why for me as a bull, that would not factor in. And two, the bull's argument will be the same, right? So the bull's argument will be, hey, why should I pass that judgment on a
Hmm.
founder that I already know, working with them for 3, 4, 5, 6, 7 years, knowing them
Hmm.
as a person, knowing their backgrounds, having a great relationship, and at the same time, I give the exact same benefit of the doubt to a serial founder that I just met that exited for 50 million personal life changing money, and now I
Yeah.
re-underwrite for this person that I don't even know and have no relationship. Awesome, take my
Hmm.
money and go big now. So for
Hmm.
me, it makes no sense as a bull to make that differentiation. I should trust the person that I already know.
Hmm. Gotcha. Okay, so maybe
But I
let's
need to, of course. So sorry. So
yeah.
I need to be convinced that the person then also has the aspiration to buy more
Yes.
land or change the methods.
Yes. Okay, so that's as good a segue as any for my next argument. For better or worse,
So back
venture
to the
is
bear.
never back to the bear, right? For better or worse, venture is never like a straight line or a very uniform, monotonic journey in any case, right? Uh, Unfortunately, quite often what happens is the decision of founder wanting to do some secondary transactions might also overlap with some pessimism in the market, other investors not being super active in the market, etc. And the reason I asked you, hey, do you factor in the valuation being lower than, let's say, the fair value of the company? So, what quite often, and this is something we've seen, maybe not in conjunction with secondary transactions, but in general, in trying to establish some sort of price discovery for a round to come together smoothly, is, let's say, in a tough market, you're trying to put together a round. Usually you then don't get the valuation you were looking for, and you take a bit of a hit. In this sort of a situation, when you introduce this element of, hey, founder secondary and whatnot, apart from the fact that the secondary by itself may be at a discount, I wonder if it also puts even more downward pressure on the price discovery or the valuation or establishing the valuation of the company. And that is where everyone around the table sort of gets hurt with the founder secondary happening, or let's say secondaries in general happening. So,
But
what do
do the bears really get hurt if no cash flows? I mean, it's just book value.
yes, but so how? So one proxy for deciding what the true value of the company is everyone, or at least everyone who matters, believes there's a huge upside from it, right? And if you're making the argument, so now put yourself in the shoes of a founder who's both trying to raise money for the venture and making the argument that, hey, we are undervalued and so on and so forth. But hey, by the way, I'm also simultaneously going to sell at whatever price you offer,
Yeah.
right? So how would that go down? What I'm trying to put you in this situation, uh, whether we like it or not, there is cyclicality to the venture cycle, and we do, as we inevitably always do, go through these down cycles. Then how do you put like a floor or a backstop? Because that gets very hard when you're trying to juggle both simultaneously.
So even the bull would have to conclude here that only a founder should only, even with a bull,
Mm-hmm.
behind them or next to them should only try to sell into a super liquid, oversubscribed
Hmm.
demand for shares. And two, even the bull would tell that founder, I've never met a different bull, would tell that founder, hey, disconnect the discussion about secondaries from the discussion about fundraising. Because
Hmm.
otherwise, like the bear is saying here, you're going to represent two sides of the same coin
Yeah.
and they both don't mesh with each other.
Yeah, this actually reminds me. I don't know if you remember this one, Patrick, from I think 3 years or so ago. We were talking to this company which was growing pretty fast, and there was an unusually large share of the round they were trying to raise at, I would want to say, Series A plus Series B stage, reserved for founder secondaries, which immediately we thought was a red flag and uh, as a clear red flags everywhere, like why is like a disproportionate share of the round being reserved for founder secondaries, because at that point what you're doing is the founder is simultaneously selling and selling shares but also selling the prospect of the company, which is you can maybe pull it off very rarely some of the time if you're in a bubbly market, but the moment the froth in the market disappears, you're removing any backstop on the company's valuation. It'll come crashing pretty hard if you don't
Yeah,
manage that dance very effectively.
yeah. Yeah, that makes sense. Now, the bull argument
Mm-hmm.
and the bull for founder secondaries that I am,
Mm-hmm.
I will also tell you there's one more factor that will actually make me more and more bullish, and that
Mm-hmm.
is the longer the founders have been underway. So,
Mm.
if you consider a company, for example, that is 20 years underway, right? 20
Mm.
years, maybe a bit money raised, maybe bootstrapped, but they've been working at it for 20 years,
Mm-hmm.
but you discover something as a shareholder where actually perhaps the market timing is now better. Perhaps, hey, this product has matured so much, it's unreachable now.
Mm-hmm.
And if I throw rocket fuel at it, I can legit maybe 10, 50, or 100x it from here. So if I now want the founders to recommit to my 10x, 50x, or 100x thesis, I mean, is my pitch going to be to the founders, hey, but we're not going to put more potatoes in your barn right now. You now have to go with me after you committed to building this business for 20 years.
Mm-hmm.
And you did all your fields for 20 years. You put all the hard work into the soil. I look at your barn and the barn is empty,
Mm-hmm.
but follow me on this one. We should
Mm.
really change the methods on the field now. Let's throw more fertilizer
Mm.
on top of it. And then it's going to go really big. I'm not going to convince the founder that that's just
Mm.
human. So the way I'm going to win that argument with the founder is, hey, let's put some potatoes in your barn
Yeah.
and I'll help you with my fertilizer to make sure that your field is really going to blossom and you're going to be the
Mm-hmm.
potato king tomorrow. And today you're already, potato king junior.
Yeah. Look, I think I feel the Bears would definitely have to concede ground where there's a question of very legitimate case of founder burnout, or as you say, not enough potatoes in the shed sort of a situation. We are all human at the end of the day, for better or worse, or at least until AI also founds companies and artificial general intelligence is what is creating ventures and also evaluating ventures simultaneously. Uh, I would agree. I think one aspect I would maybe ask you, which maybe applies in both these scenarios of the picture you painted, for founders who've already been at it for a long time, as well
Mhm.
as for a founder who's had a very meaningful first exit and now starting over the second time, would you apply a higher bar for the level of ambition that hopefully you're able to see or underwrite in these kinds of founders for this next journey
That's
that
a
you're going
great
on?
question. So let me run with that, right? So in the bull is making the argument that, hey, I'm backing serial founders here, and
Hmm.
they might have the bank account already. They might have
Mhm.
changed their life already, and that's why they take the big swings now. Now, if that type of a founder on the second or third company that I now backed asks me to do a secondary for 1 million,
Mhm.
that will even shake the bull's
Yes.
confidence. That
Yes.
will make the bull question, hold on, what
Hmm.
is going on in this company? Because that looks like an exit valve. That looks like something I should better also know,
Yeah.
right? Because it's not going to move your personal needle. That's the
Hmm.
point, right? So if
Yeah.
it doesn't move your needle, there's actually no reason of doing the secondary
Yeah.
at all, right? And
In
so
fact,
that wouldn't even work for a bull.
combining a situation you presented and a situation I presented, I would imagine if you're talking to a founder who's already had their share of liquidity, if they actually see a highly undervalued situation, you probably might also ask, hey, why would they not also go a little bit deeper and also invest?
Exactly.
Yeah.
Exactly. So,
Hmm.
which is actually a situation I currently have in my portfolio. I
Okay.
think we had a similar one last year. So, two exited
Yes.
founder teams.
Hmm.
Companies doing quite well. The capital markets not appreciating the asset to the
Hmm.
degree that the founders thought they should get appreciated. They raised funds, etc., but the share price they thought should be higher.
Hmm.
And the primary value both these teams actually attached to their companies and the share price. Both founder teams actually invested their own money,
Yeah. Yeah,
substantially so.
we've actually seen. You're right. We've seen a few such cases in our portfolio, and it's actually quite heartening. It does provide a backstop, even in cases where the rest of the investors don't support the case. When founders step in to put it, it's actually very hard to argue against the company not being valued more than that. So
Hmm.
that has the opposite effect of the scenario I painted
Yeah,
earlier.
yeah. So as a bull, what my co-investors think, unfortunately, oftentimes is opaque to me.
Hmm.
I don't know that, and even if I were to know what they think, my hunch as a bull would be that perhaps they would be more the bears,
Hmm.
because I tend to think that they are more prevalent in VC. So as a bull, that's somewhat a problem, but unfortunately an uncontrollable one. Because if I actually think this is the best way to build a company, and at some point to re-underwrite the next 10x or the next 100x, but other shareholders around the table would be the bears, it doesn't help if I'm the bull. So the
Hmm.
onus is on the founders of actually carefully curating and selecting shareholders, all of which are either bears or either bulls when it comes to
Yes.
secondary founder secondaries.
Hmm. Indeed. Yeah. I mean, the way, and maybe now removing myself temporarily from the position of being a bear, uh, usually when I look at these situations, in the case of a exited founder, you're right. Just like most other VCs, I see that as a net positive. But I always ask my question, hey, it has to be a much more audacious, a much more ambitious plan.
Hmm.
It can't be something which it needs to be life changing in a more exponential degree, because this person has already seen a life changing event.
Yeah.
So you cannot settle for a like a semi life changing event, if you will. You need something with a bigger bang to it than the previous adventure.
And that can be expressed in monetary terms. Sometimes these founders might also express you their mission
Hmm.
in other terms. Now, it needs to be authentic. It needs to be believable. So if it's like something very, very fluffy, oh, I want to improve the world, that's not a
Hmm.
mission. That's
Yeah.
something else. But we have founders in our portfolio that legit want to kill a specific incumbent.
Hmm.
That can
That's
be your
right.
mission on the second tour.
Yeah, that's right.
Sweet. So, look, I think it's a very good hypothetical argument
Hmm.
of the bear and the bull. Um, every founder that reaches or crosses Series B will be confronted with these questions at some point.
Hmm.
So I think it's good to put this one in the inventory in the personal library and then apply to your specific context.
Yeah, absolutely.
Sweet. So Shub, our little ritual. What is in your calendar next week that you're excited about?
There's one theme that I think we touched upon sometime last year. The topic of surety bonds and how they're, inflecting as a potential new theme introduced by the regulators in India. We've come across like a bright new prospect in that space. Very excited to dig more into that opportunity and see what happens.
Sweet. In my calendar, the most exciting part is what's not in the calendar. And that is finally, after many, many weeks, my calendar is lighting up again. And I like these
Nice.
weeks where I have some space for thought processing, preparing decisions, etc. So for me, that's,
Hmm.
it's looking
Sounds
to be
like
a
a
good
very
week.
nice week indeed.
Yeah. All right, dear Bear, thanks for sparring with me.
I hope you have enough room for all those potatoes, man.
I don't know. It's, the best storage of my potatoes is underground.
Nice.
All right, so see you next time.
See ya. Bye bye.